Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. I am very excited to be here with all of you today. And the reason for that is that this is episode 100. We're actually at triple digits now, ladies and gentlemen. So, number one, I can't thank you all enough for the following and for your attending to all our podcasts on a weekly basis. We're getting more and more people every single week attending our podcast, and we've been doing this now for almost 2 years. So once again, this is your tax-free life podcast. And as I said to you the last couple of weeks, I wanted to do something very special for all of you in our 100th episode. And what I have done is I went back to the first episode. Boy, we were babies back then. And then I've been trying to get some information. Obviously, I can't provide you with everything, but I wanted to do a recap on some of the things that I always feel that would be very important to all of you. Because if you can walk away from this podcast that we host every single week, and you can take a piece of idea with you, then I think I've done my job, and that would be a win-win not only for you, for your family, but also for your business if you happen to have one. So today I just want to give you a recap on a lot of the stuff that we've talked about, but I want to emphasize some of the critical points that I think are very important for all of us to keep in mind as we start to prepare for retirement and hopefully for a very long and successful retirement life. So I'm very proud of the fact that we've been doing this now for quite some time and reaching this milestone of 100 episodes. It's a big thing because now we are triple digits. You would be surprised how many other podcasters, they do 15, 20 podcasts and then they quit. I'm never going to quit. I'm here to help you all. I'm here to provide you not only information, but also education, because I always say that information without education always leads to failure. So I want to start and talk a little bit about, the fact that and the vast majority of clients that I engage for the first time, and if they happen to be in retirement, and if obviously when they come in for the first time, they got to bring in their tax returns. So I can do an audit on their tax return. And you would be very surprised to see how many Americans, how many millions of Americans are actually wasting away their standard deductions in retirement. When you put money in some kind of a qualified plan, whether it's a 401k, IRA, 403b, 457, you all know that the money that you put in is pre-tax and then the money grows tax deferred. But then when you pull the money out, you're supposed to pay taxes on the whole thing. Now, there's a way to be able to get some of that money on a tax-preferred and tax-free basis, and that's by using your standard deductions to offset the distributions out of those accounts when you take money out of your 401k and IRAs. Now, every year, when you take money out, you're going to be receiving a 1099-R from the company that you took the money from. And then obviously you got to factor that into your tax calculations to determine how much of that money is going to be taxable. But if you have enough amount of standard deductions on your side of the ledger, you may actually be able to get the best of all worlds. You can put money into an IRA or a 401k or a 403b, do that on a pre-tax basis, have that money grow tax deferred, and then when you pull it out, you can also pull it out tax-free because you can do what I call a standard deduction offsetting. So if you do it the right way, then obviously you can have your cake and eat it too. What I do find is that whenever I do audits for clients, many of these clients have wasted away a portion of their standard deduction. And when I bring it to their attention, one of the things they say to me is, well, Bert, I really don't need the extra money, so why am I going to take it? Well, you'd be a fool not to take it, because if you don't need the money, then you can do a Roth conversion. So now you can take money that would have been taxed for the rest of your life, put it into a Roth IRA without having to pay the tax, because you can offset it with a standard deduction, and now that money will continue to grow as a Roth IRA on a tax-free basis for the rest of your life. So if you do have some room inside your standard deduction, then why wouldn't you want to use it? Why would you want to let it go to waste? That makes no sense to me. And then obviously once I bring that issue up to the vast majority of clients that I engage, they basically say, Bert, I wish somebody would have said that to me 3, 4, 5 years ago when I retired. So I'm telling you now because, that's where tax planning comes into play. That's where I start using my tax planning software that will determine exactly how much money you can actually pull out of your qualified plan accounts, hopefully on a tax-preferred, tax-free basis, without you having to pay taxes on those distributions by using your standard deduction. So again, I can help everyone, but I can't save everyone. And some of you I can save, but some of you are not going to be able to be saved because you are so engaged in the way that you do things in the old world that you fail to realize, and you fail to look at your finances through a telescope as opposed to a microscope. And you hear me talk about that all the time. So I wanted to bring that point to your attention, because hopefully it's going to drive home a point, and then you're going to be able to make a paradigm shift in the way that you manage your finances moving forward into the future. So obviously, also remember the Roth conversions represent a major advantage to your standard deductions if you have them available, so you can get the best of all worlds along those lines. Another episode that I did, I named it What's Better, a Hammer or a Screwdriver? And obviously the answer to that is, well, it depends. And the reason why I like to make it kind of fun is because nobody wants to talk about finances and taxation, because it's just like, talking about taxation and tax planning is just like trying to get a colonoscopy. Nobody wants it, but everybody needs it. So, my goal is to make things a little bit better for you and your family, and to kind of get you to start thinking outside of the box from a business perspective. As far as what's better, a hammer or a screwdriver, let me give you an analogy that I normally use with many of my clients. And this is a wheat farm analogy of taxation. So let's say that you own a wheat farm. And the big question to those of you that may own this wheat farm, as an analogy, obviously, the question is, well, would you rather pay taxes on a few bushels of seeds in the spring, or would you rather pay taxes on truckloads of wheat in the fall? And I would argue that depending on your tax bracket, most of us are going to want to pay taxes on the seeds as opposed to paying taxes on the harvest, which is the larger one. Now, obviously, that's where you need to figure out where your taxation is going to be in the future. Because more than likely, and unless you've been a financial failure for your entire life, your tax liability in the future is going to be greater than what it is today. So you would be better off paying taxes on the seeds than paying taxes on the harvest in the fall. And the analogy for that is that when you start taking a look at your different buckets, tax buckets, and we'll talk in a little bit about those, then obviously having as much money as you possibly can in the tax-free bucket, that's where you're going to pay taxes on the seeds, but then the harvest, not only in the future, but for the rest of your life, is going to be totally tax-free. And in the perfect world, and in most worlds, your harvest is going to be much, much greater than the seeds were to begin with. So always think outside of the box when it comes to trying to figure out what's better, a hammer or a screwdriver. Now, another episode that I did, and I've talked about some of these things for several episodes, but the reason why I want to mention it today, by giving you kind of a feedback on everything that we've talked about for the last 2 years, is that some of the episodes are going to be very, very driven and are going to make a total difference in your entire life, and a positive difference in your life. So one of the episodes that we did, it was called The Fatal Four of Retirement. And these are the things that can actually negatively impact your success in retirement. So if any one of these 4 things happen to you, and you haven't planned for it, and you haven't prepared for it, and you haven't looked at your retirement planning and your retirement distribution planning through a risk management perspective, then chances are you're not going to be very successful in your retirement life unless you take care of these 4 that we'll talk about in the next few minutes. Now, the other thing I always want to share with all of you, and this I get often, I just had this happen, I think it was a week ago with someone that I had been talking to, and the vast majority of the audits that we do for clients, everyone is always thinking about offense. Let me put money away. Let me see what kind of rate of return I'm getting on my money. I don't want to take any defense. I don't want to protect my assets because I want to get a high rate of return if I possibly can. Well, as of this podcast, we are in a pretty bad week in the stock market because of the coronavirus, and also because of the people that are running for the upcoming election on the Democratic side of the House. So there's a lot of fear about increases of taxes and socialism, and we'll get into that in the next few minutes as well. But the market has dropped over 2,500 points in 3 days. Well, if you happen to be in retirement, you have some issues and you have some concerns to deal with. And the reason why the market has dropped for you is because you haven't done any proper planning when it comes to having a balance between your offense and your defense. Now, in football, offense puts people on the stadium, but defense actually wins Super Bowls and championships. In a perfect world, you want to have the right combination of both. You want to have a really good offense, and by the same token, you want to have a top-notch defense on your side of the ledger, and the same thing happens with finances. So what are the 4 fatal of retirement? Number 1 is, how to protect yourself and your family against the risk of dying too soon. See, tomorrow's promised to no one. Obviously Kobe Bryant comes to mind. This just happened a month ago, 41-year-old with his daughter and obviously other people in the helicopter. They woke up that morning, they prepared to go to a basketball game, and they never thought that they would not make it home. So I always tell each and every one of my clients that tomorrow is promised to no one. So protecting yourself and your family against the risk of dying too soon because tomorrow is promised to no one is very, very important. Life insurance plays a major, major role. And I don't care if you're retired or not, each and every one of you has a need for life insurance. Now, you're always going to carry life insurance in your entire life, whether you pay for it or not. Either you're going to be self-insured, or you're going to pay a premium to an insurance company so that insurance company can protect each and every one of those individuals that you care and love. Remember, people normally buy life insurance for 2 reasons and 2 reasons only. They either owe someone or they love someone. Now, you can use it, you can always buy it as a supplemental retirement plan and disability plan and so forth. There are many other areas, but primarily most Americans buy it because they either owe someone or they love someone. Now, in my case, I owe and I also love. So I want to make certain that I carry as much as I possibly can because I want my family to be just as well in the future, whether I'm here or not, than that I'm here today. So I want to make certain that they're fully protected from that perspective. The second risk that is very critical for all of you and for all of us to pay attention to has nothing to do with dying too soon, but it does have to do with living too long. Americans are living a long life today. They're actually living a lot longer today than ever before. What used to kill us 30, 40 years ago is no longer doing that. Now, it may leave you disabled. And by the way, if you live long enough, a lot of the things that are in the Fatal 4 will happen to you anyways. So, in the area of living too long, the one major concern for the vast majority of clients that I engage, not only my existing clients, but clients that I engage for the first time, is the risk of running out of money before they run out of life. And the longer you live, the more careful you're going to have to be regarding your money management decisions and your distribution, your retirement distribution planning. Sadly enough, what I do find often is that many of my new clients have never created any type of guaranteed pension plan for themselves and their families, whether they had a pension plan at work or not. Even if you don't have a pension plan at work, you do have the ability to create a guaranteed income and or a guaranteed cash flow for the rest of your life if you do it the right way. So living too long is a big issue because Americans, by the way, the fastest growing generation in the U.S. are people that are between the ages of 85 and 105. As a matter of fact, insurance companies now, their life insurance contracts used to endow at age 100. Now they endow at age 121. And who better to know from an actuarial standpoint how long people are going to live in the future than insurance companies, because that's what they do for a living every single day of the week. Now, the third of the Fatal 4, so we've talked about the risk of dying too soon and the risk of living too long. The third of the Fatal 4 is the risk of living with a disability. And the longer you live, the higher the propensity for disability. As a matter of fact, if you're a married couple and you're fairly healthy today and you're age 65, there's a 70% probability that one of you is going to have a need for long-term care in the future. And long-term care can cost anywhere between $350,000 and $500,000 in a lifetime. And the challenge is that most Americans have done very little planning, not only for retirement distribution, but let alone for retirement distribution while going through a long-term care need. Now, in order for you to qualify for long-term care, there are activities of daily living. If you cannot perform 2 of those, there are 6 of them. But if you cannot perform 2 of those, then you would qualify for a tax-qualified long-term care benefit. Now, you can self-insure that benefit, meaning that you're going to say, you know what, Bert, I'm going to take the risk, and we'll see what happens. Hopefully, I'm going to die in my sleep, not needing long-term care. But if you happen to need long-term care, either you or your spouse, you may use that money so fast, so quick, and at such a rate that there may be nothing left for your surviving spouse after your passing. So not protecting the risk of living with a disability is a very, very selfish decision that Americans are taking today. Now, you can take care of that by purchasing a long-term care policy, although we've talked about the risk of purchasing a traditional long-term care policy. Premiums are not guaranteed. Insurance companies, do not have enough experience because long-term care is a new phenomenon. Living too long is a new phenomenon. So insurance companies are still trying to price it correctly. But there are now life insurance policies available in the marketplace, again, that not only will it protect your family in the case of dying too soon, but it will also protect your family in the case of a critical illness, a chronic illness, or a terminal illness that may happen to either you or your spouse at any point in time. So therefore, if you have the proper life insurance in place with all of those long-term care riders, then someone is always going to need a benefit. If someone is always going to collect a benefit. If you happen to die in your sleep, then your surviving spouse and your beneficiaries will collect a death benefit tax-free. If you had a need for long-term care, then you can collect a portion of it, and then upon your passing, the rest will go to your beneficiaries tax-free as well. So even the benefit that you received while you were alive would be tax-free because it would qualify as a tax-qualified benefit. And if you used it all, well, then you used it all. But at least someone is always going to get a benefit, as opposed to a traditional long-term care policy that if you pay for it over 25, 30, 35 years, and then you die in your sleep, then that money went to waste. And not only did you lose the money, but you also lost the opportunity cost of what you could have done with that money. And then obviously, not only you, but your family is out of that money as well. And then the last of the fatal four. So we've talked about the risk of dying too soon, living too long, living with a disability, but the last of the fatal four is the risk of living with eroding factors. And eroding factors are anything that can erode the value of your money. That includes taxes, inflation, stock market volatility, as what we're seeing today, interest rate volatility, propensity to consume, mismanagement, lawsuits, anything that can have a negative impact on your cash flow is an eroding factor. And there are many things that you can do along those lines. Number one, it's important to invest in products that can stay ahead of inflation. Always remember that inflation is not tax deductible. So if you have a 3% inflation rate, just getting 3% of your money is not enough, unless it happens to be in a tax-free account. Because otherwise you have to pay taxes, and then you hope that the net will be 3%. So depending on your tax bracket, you may have to be earning 3.5 to 4, maybe even a 5% return, depending on how high your tax bracket may be. So managing the fatal four retirement puts you on an excellent defensive position in which you can win the Super Bowl of your retirement life. But what I do find many a times is that everybody takes an offensive approach. You'd be surprised how many clients I have and that I meet for the first time that do not have their principal protected in their investments. So therefore, they're going to suffer dearly. They're actually suffering dearly when the market drops and when the market crashes or collapses or whatever it may be. So you cannot have all your eggs in one basket. And by the way, every single retiree that I manage, and I manage a lot of them because that's a market that I'm in, will always tell me that they wished they had more guaranteed income than they have today. So cash flow is king. And if you have guaranteed cash flow, even better for you and your family. Now, another episode that I did a while back dealt with the financial impact of the U.S. national debt and unfunded liabilities. And I want to talk a little bit about what I call the imbeciles in the room. Obviously I've been paying attention to the Democratic debates. And by the way, this is not a political statement. This is an economic statement. Because mistakes are being made whether you're a Democrat or you're a Republican. So, I'm someone that I'm always looking at all of these things through the eye of an economic decision, nothing more, nothing less. So what I'm about to share with you is from an economic standpoint. Now, I call this part the imbeciles in the room. And the reason for that is that, you sit around and you watch TV, as I did this week, and you watch these politicians making asses out of themselves, talking about things that they have no clue about, and they have no understanding of economics and money management and so forth. And one of the first things that I ask all of them, now obviously we have Bloomberg, and then we have the other guy who's a billionaire as well. But the vast majority of these politicians that want to take all of your money, all of my money, and they want to take as much as they possibly can. See, they've never had to sign the front of the check. They only sign the back of the check. Anyone can do that. Now, most of these politicians, they have never owned a company. They have never hired an employee. They have no idea what it costs to maintain an employee. They've never had to pay Social Security, Medicare, payroll taxes, workers' compensation. None of them have ever had to borrow money to make payroll. I did that several years ago. Many years ago when I started my company, I hired employees. And in the very beginning, my company was not doing well. And sometimes I would have to go and borrow from my life insurance policy in order to make payroll, because at the end of the day, making payroll was very, very important for me, for the viability of my company and the viability of my family. None of these politicians have ever done that. See, all of these politicians think that they can do better with your money than you can. So I don't care whether you happen to be a Democrat, a Republican, or an independent. Always pay attention and take a look at who's after your money. I mean, these are a bunch of imbeciles that are talking about $100 trillion and everything is for free. There's nothing in this country that is for free. As a matter of fact, free is very, very expensive. Now, I hear that Mike Bloomberg is buying the election. Well, I would argue that Bernie Sanders is also buying the U.S. election because he's giving everything for free. So he's buying votes from people that obviously have no clue. They have very little understanding of economics, and they do not understand what it takes not only to make money, but how money works. So one of the things that I wanted to share with you is be careful. Be careful with your money, because the question is, who do you think is going to end up paying the ultimate increase in tax liabilities? See, everybody thinks that they're going to start raising taxes on the wealthy. Now, Bernie Sanders has said that now obviously taxes are going to go up even for the middle class. So if you make more than $29,000 a year, and you're definitely not in the middle class if you do that, then you're going to pay more in taxes. Okay? So the other question is, well, let me give you an example. Who do you think is going to pay that? So let's say that you own an apartment building, or you own 2 or 3 apartment buildings, and all of a sudden, one of these people wins the election, and now they're going to start raising your taxes. So they're going to start raising your taxes. Do you think that if you own an apartment building, you're going to pay for the taxes yourself? No, you're not. What you're going to do is you're going to start raising the rents on all of those apartment buildings that you own, and on each and every one of those apartments that you own as well. So when it's time to renew the lease, you're going to be increasing those leases in proportionate amount to what you're now being asked to pay in taxes. Same thing happens when you go to, Whole Foods. If all of a sudden you're going to start increasing the price of food, well, that price is going to pass on to the consumer. You and I are the consumers. So whenever you think that somebody else is going to be paying the taxes and not you, always remember and always try to figure out whether you are on the giving end or on the receiving end of the tax liability. The other thing that I hear from these people is, well, we're going to go to $15 an hour. Obviously, none of them have ever had employees. Now, if $15 an hour is good, well, wouldn't $20 an hour be better? How about 25? How about 30? How about 45? How about 50? See, what they don't realize is that, number one, $15 an hour is going to create employee reduction. So if you own a business and all of a sudden you're paying $10, $12 an hour, and you got to increase it to $15 an hour, then what you're going to do is now you're going to have a higher cost. So if you're an employer, you're going to have an increased employer cost, and you're going to have to increase the cost of goods that are being sold. It's not only the $15 an hour that you're paying that employee, but now you got to increase the payroll taxes. You got to increase the FICA and Medicare taxes. You got to increase the workers' comp assessments because insurance companies are going to charge you based on the payroll that you have. And that's going to force a lot of small businesses to either close their doors or file for bankruptcy. The market is the better one at determining what the ultimate pricing is going to be. Not only that, if you happen to be a kid in high school, or you have a son or a daughter in high school, and they're going to go work for Burger King, and they're going to be told that they're going to be making $15 an hour, well, those jobs are now going to be replaced by robots. So now your son and daughter or grandchildren may not have the ability to go out and find that first job as all of us did many, many years ago. You know, the other thing that is, and this is the last point that I want to make regarding the national debt and unfunded liabilities. Remember, we're at $23 trillion and counting. The national unfunded liability is at $126 trillion and counting. Now, the unfunded liabilities are those promises that the U.S. government has made to all of us that they don't have the money to keep. And those numbers are continuing to go up every single year. Another big issue, and we encountered that for the first time in 2019, the first time in U.S. history that the national deficit, and that's a difference between what the U.S. government brings and what we pay out, hit $1 trillion for the first time in history. Let me repeat that. It hit $1 trillion for the first time in history. So if you don't think that taxes are going to go up in the future, then you're not really listening to my podcast, and you haven't been listening to the last 99 episodes that I've been covering, because you have to take control of your tax liabilities. And in order to do that, you have to be able to understand how the financial buckets, which is the next topic that I'm going to cover now, are going to have an impact on you and your family moving forward into the future. Also, I just found out last week that Canada increased taxes on the wealthy, and they a year later they have what is known as a Canada tax increase era, meaning that they collected less in taxes than they were collecting before. And again, this is why I always talk about the imbeciles in the room, because you can increase the tax rate at which you're going to be taxing the wealthy, and you can put a number on the wealthy, whatever that number you may want to put on. But there's a difference between the tax rate and the tax base. See, when you're taxing a lot, that means that the assets are not growing as fast as they should be. So when you lower taxes, the asset base in which you're drawing those taxes from gets higher and higher every year. So although you may be taxing a lower tax rate, the income generated, because the tax base is so much higher, is much greater than otherwise it would be. I use a software program which is called Truth Concepts, and it allows me the ability to actually show clients what is the proper tax base and the tax rate that should be charged in the United States now, and in the United States for each and every American. Now, politicians are not going to tell you that, because they're too imbeciles and they're too stupid to know the difference. And the actual tax rate that should be charged is about 14.6 to 15.3%, because it allows for the government to generate a much higher tax income, because of the fact that it's allowing the base to grow so much faster. So at the end of the day, you end up on the right side of the equation, as opposed to doing it the way that Canada is doing, or the way that these imbeciles that I'm now watching every single week in debates are trying to do. Another episode, and then we got this one and one more, and then we'll be done. But another episode that I did was understanding the three financial buckets, and all of the stuff that I can tell you today, and all the things that I have already covered with you today, and also in the past, comes down to you having a fully understanding of your taxable buckets. And there are three of them. You have the taxable bucket, you have the tax-deferred bucket, and last but not least, the tax-free bucket. Now, the taxable bucket means that the money that goes in gets taxed. Every year you pay taxes, and then when you sell the accounts, you also have to pay taxes. And the taxable buckets are comprised of your checking accounts, your money market accounts, your savings, your CDs, traditional mutual funds. Now, you may say, well, Bert, that really doesn't work well from a taxable standpoint, and the answer is correct. You are correct. The taxable bucket is horrible from a taxable standpoint, but we all need money in the taxable bucket because it is your emergency bucket or the opportunities bucket for something that you may want to do in the next few months. So you need to understand what the optimum amount should be. It should not be more than 6 months of expenses or opportunities or a combination of both inside of that bucket. Because obviously you want to limit the exposure to taxes from one year to the next. The next bucket is a tax-deferred bucket. Most of you know that bucket. That's where you're going to put investing for your retirement. That's your 401k, your 403b, your IRAs, your 457s. If you happen to be a public employee, that would be your DROP, your Deferred Retirement Option Program bucket. The money goes in pre-tax and money grows tax-deferred. And then when you pull the money out, you're supposed to pay taxes on the whole thing, unless you've done proper tax planning and you're not wasting away your standard deduction. But nevertheless, the tax-deferred bucket is one that also has an optimum level that you should fund it to. Anything above that should go somewhere else. So once you have the optimum level in the taxable bucket, and you have the optimum level in the tax-deferred bucket, and looking at your standard deductions, and for each and every one of you, the numbers may be different. But if you have in the tax-deferred bucket anywhere between $350,000 and $450,000, you would be okay. Anything above that, now you're running into major problems, because now your Social Security benefits are going to be taxed upon distribution of your retirement accounts, and also your Medicare premium can go through the roof, and that's definitely not something that you would want to do. In a perfect world, if you do it the right way and you do proper tax planning, you should not pay taxes on your Social Security benefits from that perspective. And then last but not least is a tax-free bucket. Whatever doesn't go into the taxable bucket or the tax-deferred bucket should definitely go into the tax-free bucket. And the tax-free bucket is comprised of your Roth 401ks, your Roth IRAs, your municipal bond funds, and I'll put an asterisk on municipal bonds. And then last but not least, your 7702 plans, or your cash value life insurance plans. Now, the reason why I put an asterisk on municipal bonds is that although the interest that you generate from a municipal bond is federal income tax-free, those numbers get added on to the provisional income calculations that I do with my clients every single year to determine what percentage of their Social Security benefits or your Social Security benefits will be taxed in retirement. So if you do it the right way, you would want to have the vast majority of your money in the Roth, in the tax-free bucket, because that's going to give you that tax-free growth that all of us need to have. Remember, if taxes were to go up in the future just by 1%, you would be better off in the tax-free bucket. And for those of you that may not know this, your taxes will go up guaranteed January 1, 2026, because the Tax Cuts and Jobs Act that was signed by President Trump in December of 2017 that took effect January 1 of 2018 will now sunset December 31st, 2025. So when you wake up January 1, 2026, your taxes would be higher and your standard deductions will be lower. So you need to make certain you have a 6-year window in which you start doing some money management shifting and moving your assets from forever taxed to never taxed again. The importance of principal protection was another episode that I did, and that is a huge one, especially nowadays. You got to remember that, there's a big difference between the accumulation rate and the distribution rate. Most of you have been thinking about accumulation all of your lives. That's why you've been taking that offensive position. But when it comes to distribution rate, it's a paradigm shift that you have to make, because the rules of engagement totally change. I normally use the Mount Everest analogy. And in fact, as I've said it many times, so I'm not going to go into a lot of details, but, if you wanted to climb Mount Everest, what would be your goal? 99% of you will say, well, to get to the top of the mountain. I would argue that's only half of the goal. The goal is to make it to the top of the mountain, take a picture, and then make it safely back down the mountain so you can tell the story to your family and friends. The challenge is, and this is true, that the vast majority of the people that die, over 70% of the people that die on Mount Everest, do not die on the way up. They actually die on the way down. They're tired, they run out of oxygen, they get into trouble. While the vast majority of the people that die, think of Mount Everest as your retirement life. As you're climbing the mountain, you're putting money away you're still employed, you're still viably employed, you're putting money away into your 401ks, IRAs, retirement accounts, investments, real estate, whatever it may be. And when you get to the summit, that's when you get to your retirement date where you're going to pull the trigger. Whether it's age 60, 65, 70, more and more of my clients are delaying retirement, which is a good thing. And then as you start coming down the mountain, or you start to take retirement distribution, then obviously you're coming down, and that's your distribution rate. There you're going to have a lot of booby traps along the way that you got to pay attention to, because otherwise you're going to run out of financial oxygen, and you're going to die in the middle of the mountain coming down, and you're not going to make it to the very end. Remember, you never want to run out of money before you run out of life, so it's important that all of us understand that. Now, also, please bear in mind that retirement distribution is about cash flow and distribution rate. It is not, and I repeat, it is not about the accumulation rate. And the sequencing of returns can actually hinder the best distribution strategy in the world. And that's something that we're seeing today. See, if you are now in retirement and you need to take money out of your retirement accounts, and your account values continue to go south because there's a stock market correction, guess what? Now you're going to accelerate the depletion of your assets, because it's not only the fact that you're taking money out, and if you didn't do proper tax planning, now you got to pay taxes on all that stuff. But also, the market is compounding the problem, because you're losing assets as you're taking distributions out. Think if you would have retired in 2008, 2 or 3 years later, your retirement life would have looked a lot different than in 2007 when you were thinking about retirement, because of the crash that happened in 2008. And then the last episode or topic that I want to discuss with all of you today, and because this is episode 100, I'm taking a little bit longer, so if you're in a longer drive, you can enjoy it more so. But I want to talk a little bit about the importance of life insurance in retirement, which is something that many of you have no clue, have no idea. Some of you actually reject the thought of owning life insurance in retirement. Remember, you're going to own it regardless. So you're either going to self-insure and carry the liability yourself, or you're going to pay a premium to an insurance company in order to protect your demise, your premature death, and your family for that matter. Now, if you owned life insurance and you've done it the right way, life insurance is going to give you the ability to increase the distribution rates in retirements on every other asset that you own. See, if you have $1 million in assets, you can only take 3 to 4%. So in reality, you only have anywhere between $30,000 and $40,000 of cash flow because you cannot invade principal unless you own life insurance, because you need to have asset insurance, and life insurance in retirement becomes asset insurance. Now, obviously, if you own life insurance, then you can start invading principal and interest out of that $1 million, because upon your death, you don't have to worry about running out of money and not leaving enough for your surviving spouse, because the life insurance is tax-free. Life insurance death benefit is going to replace that principal that you took out in order to maintain for you and your family a much better retirement life. Now, life insurance also gives you the right to invade the principal, as I have just said. So having the ability to not worry, and you can actually buy an immediate annuity and not even have to worry about income for the rest of your life, and create a guaranteed pension that you cannot outlive. I mean, that's a beautiful thing that only and only a properly designed 7702 plan can do for you. Now, life insurance product design is paramount. One of the areas that I specialize in, and I send many of you information on this, is life insurance auditing, because my job is to repair the mess that everybody else has made. So if you have the right 7702 plan in place, then you can accomplish so much more than you would otherwise, because always remember that coming down the mountain of retirement, or the Mount Everest of retirement, is about a higher and guaranteed distribution rate and not an accumulation rate. If you own a life insurance policy and you don't have anyone that has the ability to do an audit for you, feel free to reach out to me, and I'll be more than happy to help you with that. And also, a lot of the new life insurance and 7702 contracts provide those long-term care riders that I talked to you all about at the very beginning of this episode, when we talked about the risk of living with a disability, which is one of the fatal 4 that I spend a lot of attention and that I spend a lot of time with when I deal with each and every one of my clients. So the life insurance long-term care riders are critical in retirement, because you can accomplish so much and you can protect so much. And if you have proper long-term care and you have a need for it, guess what? You don't have to invade any more principal in your retirement assets. You can continue to take the income that you were generating, because those riders are now accomplishing and providing you more income on a guaranteed basis and on a tax-free basis, where you can continue to maintain your standard of living and not create havoc, not only to you if you happen to be the person with a long-term care need, or to your surviving spouse in the future. So those are things that are very, very critical. I hope you have enjoyed this. Again, it's episode 100, so I wanted to give you a recap of the 7 out of the other 99 episodes, but I picked 7 of them that I thought would be very, very important for all of you today, and I wanted to cover that. Always remember that if you need to pick my brain and you want to ask me any questions, please feel free to reach out to me. You can call me at area code 786-766-1042. Let me repeat that, area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at gablestaxgroup.com. And always remember, as I say every single week, my goal for each and every one of you, basically each and every one of us, is to kind of help you and your families change the way that you see things, because when you change the way that you see things, the things that you see change. Again, once again, I love you all. Thank you for following and being part of this great podcast family. We're triple digits now, and we're going to keep on going every single week. So all of you have a wonderful, wonderful rest of your day. Take care. Bye-bye.